top business stories live from the Sky News City studio. UK economy returns to growth, expanding by 0.3% in November. After Allied strikes on Houthi militia, the Treasury warns of danger to the economy of Red Sea attacks from Yemen. Plus, shares of Burberry tumble after admitting profits this year will be worse than expected. Good morning, this is Business Live with me, Ian King. The UK economy returned to growth in November, according to figures published this morning. The Office for National Statistics said that the economy grew by 0.3% in November. That followed a fall of 0.3% in October. The main contributor to growth came from the services sector, which grew by 0.4%. Production output grew by 0.3% in November, following a fall of 1.3% in October. The construction sector contracted by 0.2%, but that represented an improvement on the 0.4% contraction in October. Well, here's the picture over the last 18 months or so. As you can see, it's been a pretty varied pattern. Well, joining me now is our economics editor, Ed Conway. Ed, the numbers were actually slightly better than expected, weren't they?
They were a bit better than expected. I think, the consensus forecast was 0.2%. Actually, 0.3% is a bit better than expected. But, the real story here is, you showed that chart a moment ago. You've got some months going up, some months going down. Take a step back and basically the economy is flatlining. That's what's going on here. And to some extent, that's actually a good news story versus where people thought it would be only kind of a few months ago, or certainly a year ago. People thought that we would have a recession. Well, it's possible we might just about have a recession, but actually most economists think you're going to have growth in the quarter that we're in at the moment, or at least the final quarter of last year, a little bit of growth. But the broad picture is basically not much in the way of income increases. And that's a concern because, this is the key measure of how well the economy is doing. Well, there you can see the chart. And if you kind of, take a step back from those monthly numbers, we look at GDP, gross domestic product, on a monthly basis these days, but actually it used to just kind of look at quarters. And when you look at quarters, those bars are kind of really quite close to zero when you average them out. And so that's the big picture. A stagnant economy. Not a disaster, but certainly not much to write home about. But at least it's not a kind of a downgrade, which is what a lot of people might have feared.
OK, Ed, thanks for that. Stay with us. Overnight, the UK and US launched a series of joint strikes on Houthi targets in Yemen because of attacks on shipping. On this programme yesterday, Army Daniel, the chief executive of Windward, the maritime risk information company, told us of the likely impacts of the worsening Red Sea situation.
This area exports about 30% of container trade. So in other words, most of the toys you buy in London and Hamleys, you go down Hamleys and Regent Street, 50% of the toys are exported via that route. Most of the cars from Japan and Korea and so forth are exported via that route. So that means the blocking of the Red Sea, perhaps all of the Suez Canal in the coming weeks, because I hear there might be an attack of the coalition on the Houthis tonight, which could lead to that, will influence the pocket of every single viewer of your show. By just raising prices, I think you can expect car prices to go £1,000, £1,500 each just because of this. In my view, the more this goes on, and we think it's going to go on, and the supply chain impacts are going to go on for the coming quarters, then absolutely also the UK will see more inflationary pressures. The US will, just like during COVID, although it's a tad different because the supply of freight is affected, but the demand isn't as strong as it was in COVID.
Well, Ed is still with me. Ed, I gather the Treasury has warned of potential risks to the UK economy of these continued attacks on shipping.
Yeah, they are, as you'd expect, they're kind of modelling what the potential impact of this could be. So potential higher oil prices, maybe higher gas prices as well. Remember, and you heard it just there from that guest, just how much of our trade, our goods trade, comes via that corridor, an extraordinary amount, kind of maybe half, and certainly kind of about 30% of global trade. And the trade that's passing through the Red Sea is basically, well, as of kind of a few days ago, it had pretty much halved, but potentially it's going to go down even further. And so ships are having to make longer journeys. And all else equal, that is inflationary because they are at sea for longer. You're not having as big a fleet out there able to deliver stuff. And for a country like the UK, which really depends on goods imported from overseas, we're massively dependent on it, there will potentially be an impact. But here's the thing. First of all, it doesn't seem like so far there has been much of an impact on oil prices. They're still relatively low, actually lower than they were a couple of months ago. When you're looking at the impact from the Ever Given, remember when that ship blocked the Suez Canal back during COVID? That was far greater. And that was partly because those supply chains weren't really functioning very well anyway back then. They seem to be functioning better right now. So far, at least touch wood, it does look like it hasn't had an impact on energy prices or much of an impact. But everyone's just watching and waiting. And that's why the Treasury is doing this work. They're nervous about this. But touch wood so far, inflation has been coming down a lot in the last few months. It potentially will carry on going down, given that there's an enormous kind of force from energy prices kind of coming out of those metrics. So it's kind of watching nervously and waiting, but so far no one's panicking.
OK, thanks, Ed. Now, visits to cash machines fell last year, according to figures from Link, the UK's cash access and ATM network. It says consumers withdrew £81 billion from ATMs in 2023. That was down from £83 billion in 2022. Well, the average British adult made 15 trips to the ATM and withdrew a total of £1,484 during 2023. Again, a slight reduction on the previous year. People in Northern Ireland remain the heaviest users of cash. That was the only UK region to see an increase in cash withdrawals per person during the year. Well, with me now is the Chief Executive at Link, John Howells. John, good to see you this morning. A lot of people like to use cash to budget. With that in mind, given all the focus on inflation, are you surprised to see this modest drop-off?
Well, I think what these figures show is that we are in a long-term switch from using cash to digital for payments. But cash is really, really important for millions and millions of people. And though you use those average figures of £1,500 a year, that average hides some huge variations. And what Link finds is we've got, a load of people who don't use cash at all or barely at all. But we've got 5 million people in the UK who really rely on cash. And as we increasingly go cashless, making sure those people have got access to cash through ATMs, through branches on high streets, that's the real challenge at the moment, making sure we don't exclude millions of people from buying their day-to-day goods.
Well, we'll get onto that in a moment. But, the regional variations I thought were absolutely fascinating. West Country folk really don't seem to use the cash machine very much. Is that because there's a scarcity of them?
I think it's the change which matters. So you can see that Northern Ireland, really heavy cash users, and it's gone up. London is also a very heavy cash user, but that's because there's just a lot more money in London. So actually that's declining the fastest. So I think you've got to look behind the figures and look at the actual people. And what we typically find is that it's the elderly, it's people who are on lower incomes, it's people who are in rural areas who are the heaviest cash users. That's why we need to protect infrastructure, cash infrastructure in those areas.
Yes, because you do warn today that you expect to see the number of ATMs falling over the next 12 months.
You can see the numbers. The economics of ATMs and branches is it's the usage which pays for them. As usage goes down, you start seeing ATMs and branches close, and that's a problem if you depend on cash.
It sounds like it's almost a vicious circle, because you've got obviously some businesses that discourage the use of cash, but then if it falls, then the banks just close the branches.
Well, I think it now needs managing. I think the good news last year is that the government did pass laws to make sure this is now regulated, because previously it's been up to individual organisations whether they ran an ATM or ran a branch. I think it's gone too far now, and what we need to have is laws which guarantee access to cash in a high street and in a town. And the good news is that's what the government did last year with cross-party support. The FCA is now consulting on those rules. And I'm pretty hopeful that at least for the next 5 or 10 years, every high street in the country will have a free ATM. Every town will have a shared branch, if not an actual branch of a major brand.
It's quite interesting. Communities can now contact you and do an assessment if they think the cash availability is dropping in their area. How many sort of inquiries have you had like that?
Well, we get thousands of inquiries a year. I think if you look at branches, you can see we've recommended now 100 shared branches. We're still going to see branch closures across the country, and it wouldn't surprise me if in 5 years' time we hadn't got a very large network of shared branches, hundreds and hundreds. And I think these are going to become common sites across high streets. Great news if you use cash, but also good news for high streets because they attract footfall, and our high streets need every help they can get at the moment.
What are the attitudes of the banks where they have these shared facilities? Is it generally working out where they've been implemented thus far?
Yes, I think the banks really welcome a legal framework around all of this. It's really, really hard if you're a big bank to go and collaborate with your competitors. And I think what we've got now here is Link sitting in the middle, coordinating it all, backed up by legislation, backed up by the FCA. And I think that means for the next 5 or 10 years at least, we've got cash access protected in the UK.
A few years ago, there was a bit of grousing about the lack of fivers in ATMs. Has that been addressed now?
Well, if you go onto Link's website, you've got a free app there which will show you which ATMs in the country dispense fivers. I think we've got a couple of thousand. So yes, there's lots there, but you need to just check where they are. I still like to have a fiver in my wallet. You can get it. Use that free Link app.
Likewise, I've got several of them in there right now. John, good to see you this morning. Thank you.
Yeah.
Some other business news stories for you now. And Burberry lost more than 14% of its stock market value at one point this morning after admitting profits this year will be worse than expected. The luxury fashion group said its recently launched turnaround had become more challenging against the backdrop of slowing luxury demand and said it had experienced a further deceleration in the key December trading period. Well, the warning follows similar comments from other players in the sector. Burberry now expects to report an adjusted operating profit of between £410 and £460 million for the year to the end of March, having previously indicated it would be around £552 million. Airbus has beaten its rival Boeing for new orders for a fifth consecutive year as it turned in a record performance in 2023. The European manufacturer said it secured net orders for 2,094 aircraft during the year. That was up from 820 in 2022. It's the first time Airbus has achieved more than 2,000 net orders in a single year. By contrast, Boeing, still grappling with the grounding of its 737 MAX 9 jets after an accident last week, booked 1,314 net new orders. Airbus delivered 735 aircraft to customers during the year, while Boeing delivered 528. The house builder Vistory said profits for the current financial year would be better than expected. Vistory, which was previously known as Bovis Homes, said it had a strong forward sales position at the end of the year, up 12.4% on the end of 2022. It said that the easing of mortgage rates in recent weeks was encouraging and that it was optimistic this will help stimulate demand this year for the affordable homes in which it specialises. Shares of Vistory, last time I checked, were up just over 3%. And a business aiming to develop tunnels in central London designed to shelter people during the Blitz is to float on the stock market. London Tunnels, which has acquired the Kingsway Exchange tunnels originally built in the early 1940s and which extend for over a mile beneath Holborn, High Holborn and Chancery Lane Tube Station, expects to have a value of £123 million when it comes to market. The tunnels house the offices of the Special Operations Executive from January 1944 to May 1945, and they're thought to have inspired Ian Fleming's description of Q Branch in the James Bond novels. Well, the oil price has risen on the back of the US and UK attacks on Iranian-backed Houthi militia overnight to hit its highest level since 28th of December. Barrel of Brent crude currently changing hands at $80.60 a barrel. That's up just over 4% on the session so far. On the equity markets, Wall Street finished largely flat last night following news of a tick-up in US inflation last month, but the main stock indices there still on course to finish up on the week. Well, it was a mixed session in the Asia-Pacific region overnight. The highlight for, again, the second day was the Nikkei 225. That hit a 35-year high for the second session in a row. Well, in Europe this morning, stocks are trading largely to the upside. Consumer shipping groups Maersk and Hapag-Lloyd are both higher on hopes that the strikes on Yemen overnight will restore order to Red Sea shipping routes. Here in London, the FTSE 100 is also in positive territory. Hello, that's we've got the Asia-Pacific region again there. Here's Europe. Come on, where's the FTSE? I can tell you it's up 2/3 of 1%. There we go. Yeah, it's up. Look at that. It's up 2/3 of 1% right now. Broad-based rally. The aircraft parts maker Melrose is again among leading blue chip gainers, up 2% there. I think that might be on the back of those strong Airbus figures. While Whitbread remains wanted after yesterday's strong trading update from them, the owner of Premier Inn, of course. To the downside, well, the bleeding blue chip faller is Burberry, now off 9%, so they've clawed back some of the earlier losses, while Marks & Spencer continues to succumb to profit-taking after yesterday's upbeat trading statement. Outside the FTSE 100, the defence contractor Hunting is ahead by 7.25%. That's on the back of broker comment. The wealth manager Quilter is down by 3% for similar reasons. On foreign exchange markets, it's actually pretty quiet today. Sterling very little moved on the back of the GDP data. In fact, it's off 0.25% against the greenback right now, unchanged against the euro. The single currency off 1/5% right now against the dollar. Well, here with me this morning is the lead equity analyst at Hargreaves Lansdown, Sophie Lund-Yates. Sophie, good to see you this morning. We've got to start with Burberry, haven't we, really? Absolute lulu of a profits warning.
Hi, good morning. Yes, not what Burberry wanted to be displaying to the market today. As you say, they've had a really, really difficult time recently. I mean, they've lost, 46% in the last 12 months. And this is just the latest twist and turn. So they've said today, essentially, that there is continuing weakness in global luxury demand, which is really quite surprising. You know, luxury normally hailed as a much more resilient sector. There are some, unfortunately, Burberry-specific issues going on at play here. You know, they're not as diversified as some of the other names in the space is a big one. And they're also having to invest incredibly heavily in brand, which is not helping profits either. So as a bit of context, we know now that sales for them fell about 2% in December, which is really quite significant given as I say, that resilience that is expected of them, unfortunately.
As you say, the shares have fallen by more than 40% over the last 12 months. At what point does this become a potential takeover target?
Absolutely, it's a very valid question. You know, this punishment from the market has been pretty severe, and you know that is some chatter that's happening. You know, it's got a really strong heritage brand. Its margins, normally speaking, when consumer behaviour is a little bit more normalised, and we're not going through the kind of the cost of living pressures that we're seeing at the moment, it does have a lot going for it. And you know, there may well be some questions swirling around whether or not either whether it's a takeover target, but also is now a compelling entry point as well for standard investors as well. I certainly think that's a valid question.
That's interesting. I mean, let's not forget, it is still a pretty profitable business, and it's got a quite highly regarded newish CEO at the helm as well.
Yeah, I mean, they've been through a lot of leadership and artistic leadership change as well in the last 12, 18 months or so. And they are doing, just to be clear as well, they are doing a great deal of the right thing. You know, what they've managed to do in terms of pivoting towards the higher end of the value chain in particular has really helped margins. You know, if you can charge more for your clothes and you protect that brand, then you can charge more. And that does normally help things like profit and cash flow. But that free cash outflow that we saw in the first half is really one to watch. You know, 15 million kind of walked out the door last time we heard, and that is something that we'd like to see reverse sooner rather than later.
Well, let's talk about something a bit cheerier. Vistory, good numbers from them today.
Yes, definitely. So Vistory, obviously a house-building giant, and as such, quite a good barometer for the wider economy, and they have been incredibly upbeat. Now, one of the reasons for that is Vistory is, of course, a lot more exposed to affordable housing. So that's not necessarily the same as the private market, and these are larger volume projects, which actually help keep it a lot more resilient at times when things are looking a bit shaky. So the number that I keep coming back to, for example, is that, you know, Vistory is expecting completions to fall about 5% this year. Now, that sounds dramatic, but it's much better than peers. Now, the flip side of that is that as and when the private market starts to improve, you know, we're seeing lower mortgage rates. You know, we're talking about those a lot more, that psychologically important sub 4% mortgages coming through. They might not be able to participate in a market rally in quite the same way as some of the more standard players, but their so-called partnerships business, that's the affordable housing, really helps differentiate them, and they're doing really well off the back of it.
All right, Sophie, got to leave it there, I'm afraid. Great to see you as ever. Thank you.
Thanks.
Apologies for this. We're just going to break into the business news. We're going briefly to Maidstone Crown Court. The mother of 18-month-old Alfie Phillips and her ex-partner are being sentenced today after they were found guilty of murdering the toddler in a caravan in Kent 3 years ago. We will bring you the outcome of that sentencing as soon as it happens. Still to come here on Business Live, new research suggests UK firms are not embracing AI as much as foreign competitors. Do stay with us.
I'm Katie Spencer and I'm Sky News' arts and entertainment correspondent. When you think of Glastonbury, it's mud you want and music. They're going to cross to us live in a minute. Okay.
We always were capable of doing this.
Oh, they're wonderful children as an audience.
Who did that? Maverick here on the red carpet. I'm so excited. Hello. We take you to the heart of the stories that shape our world.
Nor have I ever struck any woman in my life.
There's this illusion of power.
Are you feeling well?
I remember covering the Oscars and that now infamous moment, the Will Smith slap. You can tell from these crowds just how excited people are for the return of Pride.
These actors playing the lead roles were born long after the Sex Pistols broke up.
As a team, we've interviewed some of the biggest stars in the world.
Okay, I'll talk to you.
Don't leave me.
Yeah, okay.
There's no easy goodies. There's no easy baddies.
Thank you.
Thank you.
Bye.
I just took a shower above the clouds. You know why? Because this is the Emirates A380. Fly Emirates, fly better.
Welcome back. A little bit of breaking news to bring you that has just come from the United States, which is that the fund management giant BlackRock, a business that touches the lives of just about everyone in the world these days, it seems, it is spending $12.5 billion to buy Global Infrastructure Partners, which is a big private equity firm, best known here for being a previous owner of Gatwick Airport. BlackRock buying GIP. It's its biggest deal in some 15 years. Now, large UK companies appear to be deploying artificial intelligence less than a number of their international peers, according to research published today. The consulting and software giant IBM says 37% of UK enterprise-scale companies, that's those with more than 1,000 employees, report having actively deployed AI. That compares with 59% of such businesses in India, 58% in the United Arab Emirates, 53% in Singapore, and 50% in China. Well, joining me now is the partner and AI transformation leader at IBM Consulting UK and Ireland, Michael Conway. Michael, welcome to you. What do you put this down to?
Good morning, and really thank you so much for having me on. I think there's a number of factors at play here, and really the reasons as to why we're not really looked at in the report. What is interesting is there's a really common factor across all economies across the globe as the inhibiting factor, and that is skills. So the lack of skills is really being the inhibiting factor here in the UK, but equally across the globe as well.
Are there particular sectors that are dragging their feet?
Not necessarily. I think it's pretty straight line across the sectors here in the UK. Again, things there's perceived price, interest in price and a perceived highness of price. Also things that one might expect around data complexity and also ethics, right? So this is still nascent. We need to understand how and why we should use this and where it's best applied in the most safe and responsible way.
What is interesting, though, is that where firms are deploying AI, 2/5 of them have stepped up their activity in the last 12 to 24 months.
Yeah, as a practitioner in the field, there's not many better times to be involved. Here in IBM, it's a massively exciting and interesting time for everyone across hybrid cloud and AI. The explosion of interest and the consciousness in the public of what this technology can afford us and the productivity gains that it has the potential to give us as a society are massively, massively interesting and exciting for us to be exploring for sure.
Which are the tasks and processes where AI is being most commonly deployed right now?
So, look, not to the exclusion of anything else, but I think we're seeing three key themes in the explosion of usage of AI. One is customer care or customer service. Every business has a customer they need to look after. So, how do you automate that in a way that is pleasant for the customer and for the organisation that's offering that, whilst radically reducing costs but also increasing experience? The second one is, digital labour, back office, if you like, things like HR and finance, etc. Those really paper-heavy, heavy process-type tasks. How do you take the monotony out of those and really speed up and increase accuracy? And then lastly, it's a sort of application modernisation. How do we make the software lifecycle of creating new things with technology faster and more efficient?
Right, I'm going to ask you to get your crystal ball out here. If we were to have this conversation in a year's time, what do you reckon UK AI adoption will be this time next year?
So I think, look, the momentum is definitely with us. So that's the good thing. We're not putting our foot on the brakes here at all. It's definitely very much on the accelerator. I think it's going in the right direction. Momentum is key, and everyone can start to see how this technology is going to become so pervasive and so useful, especially in terms of productivity. I think it's a great time to be in the field. Here in the UK is no different. So who knows, numbers-wise, but certainly we're going in the right direction.
OK, got to leave it there, Michael. Thanks for joining me today.
Thank you so much.
That's it from me for the time being. I'll be back at 4:30 this afternoon with our next edition of Business Live. Hope to see you then. Thanks for joining me this morning. Cheerio.